Hedge funds are the wild, wild west of finance. Mostly everything goes when it comes to hedge funds. The focus of a hedge fund is pretty much to provide reasonable risk-adjusted returns, although that changes from one fund to the other. But typically, hedge funds are not very regulated. They could use a lot of leverage. They can have a lot of concentration when it comes to their holdings. They don't need to be in a certain sector just for the sake of it, much like maybe a mutual fund would have to. And so you have all these different regulations that don't apply to hedge funds. And that makes them a interesting vehicle for people who want hedges in their portfolio.
Hey everyone, this is Prashant and I'll be your host for the VC 10X podcast, and today we have Siddharth Singhai with us. Siddharth is the Chief Investment Officer and Portfolio Manager of Ironhold Capital, a global value-based hedge fund. Ironhold Capital delivers opportunities on a global scale in regions that are often poorly understood and widely overlooked by Wall Street counterparts. In this episode, we talk about what are hedge funds, how are hedge funds different from venture capital and private equity, what are the benefits of investing in hedge funds, what is the risk-return profile for hedge funds, the different approaches to hedge fund investing, and lots more. So without wasting any time, let's dive straight in. This episode is sponsored by my own podcasting agency called Podcast 10X, where I help VCs start and run their own podcast. While I was running VC 10X, this podcast that you're listening to right now, I asked my VC guests, why don't you start your own podcast? I mean, it's the best form of marketing for VCs. As they say, VC is a people play more than even a capital play. A podcast enables you to put your people at the front, your portfolio founders, your partners, and co-investors. It's a great way to build a brand and win competitive deals. It activates all your marketing channels in a single shot, be it YouTube or blog post or newsletter or social media. Everything gets activated in a single shot. And I get the same response from all the VCs that it's a lot of work and we don't have the time for it. I said, all right, let me handle the work for you, from pre-recording, editing, publishing to making social media clips. All you have to do is show up on a call, hit record, do the recording using the well-researched outline we provide you with, and you're done. We handle everything else. You know what they said? All right, let's give it a shot. So if you are a VC and want to up your marketing and branding game, I'd love to work with you. And if you're thinking there are too many VC podcasts already, remember there are way more VC firms out there. And if you're not standing out, you're losing out. So if you want to work with me on starting your podcast, go to podcast10x.com and book a call today. I'll add the link in the description and show notes below. Look forward to working with you. Hey Siddharth, so good to have you on the VC 10X podcast. How are you doing?
I'm great. How are you?
Very well. Thank you. And this is the first time we are going to be talking about hedge funds. So I'm very excited for this episode. So to start things off, can we first have your story and why you started Ironhold Capital?
Sure. I met Paul at our business school in Fordham, right? So we had the same intent to both start our own venture. We all were looking to, in that group, there were many entrepreneurs. So me and Paul, we wanted to start our own fund, essentially. And we had we had the same, if you will, bent. We both wanted to be value investors. We realized how value is the best strategy to follow. And so we had an alignment on that. And apart from that, we believe that we had an edge. My background coming from India, and India being the fastest growing market and one of the more inefficient markets, was certainly something that wasn't prevalent on Wall Street. Most investors sort of disregarded India as a major emerging market. Even though we invest in other countries as well, I thought India was the best place to be. And so we had an edge. And we believed that that edge could prove to be fruitful if we were to provide that exposure to US investors who either had to invest with an Indian entity, which was complicated from a regulatory perspective, or they had to do it themselves, which is, again, very complicated. So that was the beginning of Ironhold Capital.
Certainly, that's very interesting. To get to the topic of hedge funds, so you run a hedge fund yourself. So, to start that conversation for our listeners, since we are not very familiar with hedge funds on the podcast because we haven't talked about it much. So, can you tell us in simple words what are hedge funds?
Hedge funds are the wild, wild west of finance. Mostly everything goes when it comes to hedge funds. The focus of a hedge fund is pretty much to provide reasonable risk-adjusted returns, although that changes from one fund to the other. But typically, hedge funds are not very regulated. They could use a lot of leverage. They can have a lot of concentration when it comes to their holdings. They don't need to be in a certain sector just for the sake of it, much like maybe a mutual fund would have to. And so you have all these different regulations that don't apply to hedge funds. And that makes them a interesting vehicle for people who want hedges in their portfolio. They're not necessarily looking to beat the market by a lot, although some funds will be focused on that. But most hedge funds, they provide a hedge, which if the market goes up, they make money. If it goes down, they make money. Just not as much as when the market goes up. But they don't lose as much, at least in theory, when the markets go down.
Right, totally. So it's right in the name. It's you're hedging your bets to even protect your losses, protect your downside, and also go for an upside if possible. It's a safer approach to investing, much safer, I suppose, than venture capital, which is a much riskier asset class, right? So if you were to compare it with venture capital or maybe private equity as an asset class, what would be the key differences in your opinion there?
Typically, the changes come from where you are dealing with in terms of the life cycle of a business. If you're looking at just two people with an idea, maybe a PowerPoint presentation and no real business, you're looking at angel investing, then maybe they gain a little bit of traction. You get to venture capital, where you might have some revenue, you're not profitable yet, but you've demonstrated product market fit. So it means that there's potential that your company could grow. So venture capitalists are going to take over those companies, fund them, scale them, and hopefully get an exit. When I mean an exit, it implies the selling off their stake in the business. Now, who they sell off to could be many people, right? Could be many entities. It could be individuals in the public market. It could be institutions, even private equity firms. So once these businesses get to, let's say, a certain size and a certain level of profitability, they're now good for private equity. So typically mid to even late stage cycle businesses are private equity businesses, which are profitable. Private equity firms demand that you have certain profits of a multiple of which is what they would be willing to pay you. So that's the difference. Now, certain businesses want even more capital beyond just private equity, or the founder might want more liquidity. So he could, maybe cash out, maybe raise more capital more easily from a larger pool of capital. In that case, public markets is where you get that money from. And that's when you get to hedge funds, typically. So that's one major difference. Other big difference is liquidity. Because these are private businesses, if you invest in a venture capital fund, are going to get an exit when they find a qualified buyer, a strategic buyer who can acquire the business. They have a secondary sale of stocks, which is rare. Or they get an IPO, a public offering. That's how you cash out and you actually, as we call it, book your returns in venture capital. It's similar in private equity, firms as well. You're very reliant on some bigger firm acquiring your business for you to get an exit. In public markets, that's not a problem. You can typically sell out your stake if there's enough liquidity. So that's the major difference, I would say, between VCs, private equity firms, hedge funds.
Right, that's very interesting. And let's compare it with mutual funds, since I think both hedge funds and mutual funds are operating in the public markets. So what's the key difference there?
The key difference is First of all, the type of investors that can invest in both entities. Mutual funds are typically looking at retail investors who are going to have smaller check sizes. They'll maybe invest $100,000 or even $10,000. They'll probably invest a little bit every month. Their paycheck comes in. So that's one difference. Hedge funds typically will not allow any unaccredited investors. Accredited investors are typically high net worth individuals, or definition changes obviously country to country. In US, if you have a net worth of $1 million or so, you are a accredited investor, excluding your primary residence, or you expected to make $200,000 and you've made that in the last 2 years consecutively. So that's the major difference. Hedge funds are typically not available to unaccredited investors. The second difference is regulation. Hedge funds are less regulated, as we discussed, whereas a mutual fund might be required to have no more than 15% exposure to a certain sector. For instance, energy or tech or telecommunications, whatever the sector or industry breakdown might be, there's no such restriction for a hedge fund, not only in terms of industry concentration, but also in terms of individual positions. Typically, mutual funds are not going to put more than 4 or 5% of their equity capital in one company. So they tend to be more diversified. Now, regulations change. Obviously, US mutual funds are regulated differently than, let's say, mutual funds in a place like India, which are typically more regulated, I would say. So regulation and who can invest, I think, are the two big differences.
Right, absolutely. So if we compare hedge fund average returns with mutual fund average returns in any specific market, which one do you think beats the other, and which one do you think is a more safer option?
In terms of returns, I would say mutual funds, because they're long only and they're not hedged with respect to the downside, typically do around 8.5% or so after fee. Hedge funds, on the other hand, average about 7%. I mean, it would change drastically from when you measure it, right? You measure from bottom of COVID to now, it's vastly different compared to, the peak of 2021. So we have to look at returns across decades and even from when you measure it, because a particular day could make a difference. So on average, however, in terms of rolling returns or however you want to measure it, it's going to be roughly 7% with the average hedge fund, and about 8.5%, I would say, with the average mutual fund. And as far as the second part of the question, so I think it was, could you repeat that?
Yeah, so which one is the safer option to invest?
Right. So risk, unfortunately, cannot be just quantified, right? Let's say you have two funds. One owns speculative early stage companies that are not profitable, but has no leverage, or has 2 times the leverage, let's say debt to equity, compared to another fund which has more dominant, utility type businesses or railroad type businesses, which have more stable cash flows and are more proven and have a better competitive advantage compared to these early stage tech companies, maybe. Then you're looking at two different things qualitatively in terms of risk, even though quantitatively both might have equal leverage with respect to the equity. So we cannot quantify risk alone. We have to also do a qualitative assessment. So I don't think you can easily identify which is more risky, which is not. Even among hedge funds, that there are strategies that will change. There are growth-focused hedge funds, there are value-focused hedge funds, quantitative hedge funds. So risk cannot be, I think, boiled down to, it cannot be generalized.
Right, totally get it. And you just mentioned about the different approaches to investing and what are different hedge funds optimizing for, right? So tell us more about that. What are the key different approaches, the main different approaches that hedge funds follow in their investing, and what are the benefits or downsides of every approach, right? And which one you're taking, right? That as well.
Sure. So because hedge funds are the wild, wild west, they have many different strategies that they follow. So you could broadly break it down from the perspective of what asset are they investing in? Is it equity, credit, derivatives, commodities, or something else? And then B could be subclassification, which is, are you long only, long short? Are you levered? Are you an inverse fund? Those exist as well. And then the third classification would be, what's the approach to strategy, which could be value, which could be growth at a reasonable price, GARP, which could also be growth alone, and momentum, factor investing, quantitative investing, macro investing. So you have all those subdivisions and then combination of each of those categories. So you might have a equity long short hedge fund, which may not be levered, which is typically what we're talking about when we think about hedge funds. It's equity long short. That's the most common type of hedge fund. We ourselves are long only equity investors, and we don't use any leverage. Now, why are we in equities? Equities are by far the best asset class when you look at risk-adjusted returns over a long period of time. They do better than real estate, gold, way better than fixed income. And they are just, over a long period of time, bound to do well compared to other assets. They also are better against inflation. Typically, businesses can adjust inflation by passing on inflation to their customer, by increasing prices, which is not possible in fixed income. If you earn 3% and inflation is 1%, you're earning 2%. But if inflation goes to 7%, you're still earning 3% when it comes to fixed income. So that's dangerous. And over the long run, you could possibly end up with a lot of destruction of your wealth or shrinkage of your wealth. Now, in terms of strategy, we have a history of all strategies. Now, hedge funds, although have existed in official capacity for about 40 years, since the 80s, but strategies have existed for 100 years. When we talk about value investing, it has existed since the 1920s. Ben Graham, is the father of value investing. He practiced investing during the Great Depression, and he had a terrific track record. Then his disciple, Warren Buffett, and so on and so forth. That continues to this day. So it's a strategy with a long lineage of returns. And it has performed well across a 100-year period. And you can name things that have happened, right? COVID, Great Depression, Great Recession, dot-com bubble, and the Cuban Missile Crisis. You could go even further back, World War I and II. So it has survived all of that. So to me, it made the most amount of sense. And in addition, it just makes a lot of sense logically. We can get into it if you want to. But compared to macro, I think return-wise, if you look at the average return for macro fund haven't been so impressive. Quantitative funds have done well, some of them. But again, that's not my expertise. So I think really if you boil it down, it's either you're going to be in a value fund or a quantitative fund. Rest of the strategies have not proven themselves. And leverage, obviously, why we don't do long short or why don't we take leverage? The short selling is a terrible strategy, right? If you even look at the best short sellers in history, I won't take names, but if you compare their returns, compared to the long portfolios, they're abysmal. And we've seen that with the short squeezes happening recently with the meme stocks. And we've seen it previously as well. Short selling in of itself is a terrible strategy because you have asymmetry but in the wrong direction. If you're right, which you're seldom right because markets go up 30% of the 70% of the years, months, and days. They go down 30% of any period, typically, on average. So 30% of time, your shorts are going to be meaningful. And when they're meaningful, at most, you're going to double your money. That's if the stock that you shorted goes to zero. So you double your money. It could take you 2-3 years to see that happen, even if you're right. But within that 3-year period, if a stock goes from 100 to 200 to 300, eventually it might go to zero, but you're not maintaining a short position at 200. You've lost money. If it goes 300, you've lost money. And now, if it goes to zero from there, if you started off with $1, it's not now $2 because you lost it along the way. So, now you could potentially lose a lot of money if you don't really go about it in a disciplined manner. So even when the strategy works, it doesn't really work. So to me personally, it never made sense. You look at the Forbes list, you look at Fortune list. Nobody created a lot of wealth going short. Most of the wealth, or in fact, almost all of the wealth created has been created by owning a piece of a business, great business, or few businesses over the long run. So short selling doesn't make sense. Leverage is about the same. I mean, you cannot leverage in public markets because you don't know if the stock price is going to go up by 60 or 70%. You could take a leverage on your home because you're not forced to put up margin for it. But in leverage, see, you could bet on the fastest horse. But if the horse does not make it through the entire race, you never win. And that's what happens with leverage. You don't get to finish the entire race. You could get wiped out before the race is finished. So leverage in public markets is terrible. Could work with private equity firms, but not in public markets.
Right. Yeah, that's a very interesting explanation of all the different strategies that are there within hedge fund investing. And I want to understand who are the kind of people who invest into hedge funds, right? Because I've talked to some family offices on the podcast and their approach to portfolio allocation of their funds. And I've seen that hedge fund actually commands a significant portion of their funds. And in comparison, private equity or venture capital are relatively very small. It's about 10%, whereas hedge funds I've seen to the tune of 50% or even over 50%, right? So family offices are one kind of people that invest into hedge funds. So tell us about what are all the different types of people and institutions that are interested in investing into hedge funds, and for what reasons?
So the reasons depend, right? No two family offices are the same, at least from my interaction with family offices. That's what I've noticed. They all have a different view on what would work. But broadly, exposure to hedge funds is liquid. So that's one major reason. Should you need the money, should, an emergency were to come up, right? You need to put up capital in your other business that's starved for capital. So you might need to liquidate your portfolio holdings. Could be anything. COVID-like situation might come about and now you need capital. So for that, hedge funds are really good because you have liquidity on a very short notice. On a 2 or 3 month notice, you could typically get all your capital back if you really wanted to. Depends, but that's typically what you can expect. So that's major reason for why family offices invest with hedge funds. Now, the type of investors that hedge funds typically have are accredited high net worth individuals, family offices, pension funds, endowment funds. Typically, big institutions that have multi-billions of dollars to allocate, or at least hundreds of millions of dollars to allocate. Those are the ones investing into hedge funds. And the reasons, however, would change. Pension funds are different to family offices because they have an obligation to pensioners who need the money at retirement. So they cannot be too invested in illiquid assets because they might need liquidity to satisfy the pension obligations. So they like hedge funds for that reason. Family offices are typically business families that have really done well in one business, and they're looking to diversify their wealth. They created a lot of wealth by being concentrated in their core business, but now they're at a point where they would like to diversify. So that's why they invest in hedge funds. And endowment funds they have different requirements to a pension fund. They could be typically more long-term, but they have to fund the expenses of a university. So any university has professors and all kinds of expensive research labs, and you name it, even scholarships. So they come from the endowment fund, and they need to satisfy that obligation. So they invest in hedge funds mainly they invest to grow capital, right? They can be typically more long-term compared to pension funds or other investors. So I think liquidity is the key reason.
Right, absolutely. And you mentioned how it's a very liquid asset class, hedge funds, right? And we know that the private equity or the venture capital asset class operates on a 10-year fund cycle, right? It's typically for duration of 10 years. So is there any such duration for hedge funds for how long a fund can go on, and after which it has an obligation to return back the money, or it can just go on?
Typically, it could just keep going. And if you have redemptions or people pulling out money out of the fund, you can typically do so on a 3-month notice. There could be exit fees, right? Certain funds, if you withdraw money before the lock-up period, meaning the period to which you've committed in your contract with your hedge fund, typically it's a 2-year contract at most. Quite often it's 1 year. So you do have that liquidity, and you can withdraw capital on a short notice. So hedge funds have to face redemptions, unlike PE firms and VC firms, but they can afford that because they invested in public markets. You could sell a stock quickly in the public market and then pay off the investor. You can't do that in a private situation. If you own, let's say, a paper company in, let's say, Seattle, for you to sell that company off or part of it, you have to find a strategic buyer who would typically buy the entire thing or a big part of it, chunk of it. But you can't sell like 2 or 3% of it. If someone wants his money back, there's no way you can sell 1% of that paper company. You could have secondaries, but again, the market is not so liquid. So it's very difficult. So they need to have 10-year lockup periods to get proper exits in their private assets, which is not the case with hedge funds.
Right, totally. And one thing we often hear about investing is the power of compounding, right? And I believe that holds across different asset classes. But can you share more on that from the perspective of hedge funds? How does that play out as the fund matures? Because of course, people can keep taking out money whenever they want. But what's the incentive for them to keep their money invested for the long term? What are the kind of returns they can see potentially over a 10, 20, 30-year period if they keep invested in the market?
So you could expect, if you're with an average hedge fund, they'll give you about 6.5%, 7% rate of returns across many years, right? Across decades as well. It depends, of course, if you're invested. So to simplify, you have to, as an investor, be invested for the long run. And I'll give you an interesting study. Davis Advisors, maybe you've heard of them. It's a hedge fund or family mutual funds. They do many things. It's a financial firm. They did a study. And I think the period was from 2000 to 2010 or 2010 to 2020, one of the two periods. The average mutual fund returned 9.9%, and the average investor in those mutual funds averaged 3.2%, which means if you're not invested for the long run, the fund could do terrifically well, but because you were jumping in and out and you were trying to time your entry or exit, maybe, you severely underperformed the market and even the fund that you invested in. So you're not even getting the total returns that the fund has to offer if you jump around. There are investors who've held Berkshire Hathaway stock. They've invested with the greatest investor of all time, Warren Buffett. And they have not gotten half the returns because they keep buying and selling it, or they cut down the position. They don't let their money grow and compound over time. So you end up never generating any wealth. If you give you an analogy, if you stand at a bus station and you wait patiently for a bus to arrive, you'll eventually catch a bus. But if you keep running from one station to the other, hoping to catch the next bus, it's possible you might not catch any bus, right? Because you're impatient. By the time you get there, it's probably left. Or you're impatient, by the time it arrives, you've left. So that's a real study. And
right.
It's the power of compounding.
Absolutely. Very interesting insight there. So you have you know the space very well of hedge funds. Unlike me, I don't know it very well. So can you tell us what are some popular hedge funds that have done well over the years? And what has been the primary reason for their good performance over the years?
So before I say anything, obviously, I don't endorse any of the funds that we're going to speak about here. So investors should do their own due diligence. But some of the best funds have been value-focused funds, meaning they follow value-based strategy, which we can get into if you would like to. But a value-focused fundamental fund, and the best of those, they've done really well. So David Ironhold, Greenlight Capital, Bill Ackman, Pershing Square Holdings, Seth Klarman, Balpos Capital. Obviously, Mr. Buffett, but he's not really running a hedge fund, technically. His is a holding company. And then you can look at Third Point Capital, Dan Lowe, and Mr. Moesh Pabrai Investment Funds. They've really done incredibly well over decades. So those are some of the big names, but the common thread is value investing.
Absolutely. That's very interesting. So to dig a little deeper into value investing, since that term is mentioned so many times in the conversation, and in contrast to maybe growth in investing, that's the other approach that I heard from you, right? So tell us briefly what happens inside these approaches, the value investing approach and the growth investing approach, and why the value investing approach, in your opinion, is better.
So first I'll talk about value, because growth and value are related, but we'll have to go through conversation first. Value investing is, as the name suggests, figuring out an intrinsic or fundamental value of any asset. It could be a public company, could be a private company, could be real estate, could be a farm. It doesn't really matter. All of these assets have a fundamental value, which we can roughly estimate if we know what the future cash flows are from those assets. So to give you a very simple example, if you have a residential building, if you own, let's say, 4 units somewhere, and you rent those out, and then they give you cash flow on a monthly basis of, let's say, $10,000 or roughly $120,000 on an annual basis, you know the cash flows this asset will produce. And then you can reasonably forecast that this $120,000 I get, and this is after all expenses and everything, obviously. If this grows at 3 or 4%, this asset could be worth 15 times or 10 times the cash flow, which is in this case $120,000. So for a residential apartment building, you might come up with $1.2 million valuation. You might be willing to pay maybe $1.5 million for this. Maybe you're happy with 8%, 8.5%, 10% returns, or whatever. You'll have a range of returns. So based on that, you can come up with a value that you would be willing to pay to acquire such an asset. Same goes for a public company or a private company. In fact, private equity firms, the only thing they really do is project cash flows. That's how they know whether they should invest in a certain business or not. And so the value investing strategy is basically private equity in public markets. Now, you have to know the value of an asset, right? And that's what a private equity firm does. But that alone is not enough. Knowing the value is great. But the key is to buy it for a lot less. If that same residential 4-unit thing is now trading at $500,000, you know it's worth 1.2 based on fundamentally looking at the cash flows. You have a great location. You're in a very robust neighborhood in a great state that has great employment, all of those great things. But it's trading at 1.2 million. It's worth fundamentally $1.2 million. Somehow, for any reason, maybe there's COVID, maybe the owner wants to sell because he needs cash right away. He'll give you a discount. He'll sell you the real estate for $500,000. Now, the moment you buy it at that cheaper price, even if the future outlook changes, your neighborhood is now ridden with crime. The development projects that were supposed to come in to create employment don't come. Or the state is now losing jobs, losing employment, companies are going away. Even with all that, if that $1.2 million value goes to $900,000, you still made money, right? So that margin of safety, this is what it's worth, this is what I paid for it. Even if it's worth a lot less now, I still paid this amount. And that's the key. That, to me, is value investing.
Right.
And that manages risk when you think about it.
Got it.
So that's value.
Mm-hmm. And growth investing, how do you compare it to value investing?
So we could take the same example, and that $1.2 million apartment now is growing at 20%. Let's say the rents are going through the roof because of, you suspect, a lot of migration of people coming into the city seeking employment, all those things. So the same asset is now growing rapidly, but it's not available at $500,000 anymore. You have to pay $2 million to get that same asset. Right now it's worth 1.2. So you're paying more. But because it's going to grow at 20%, which means roughly it will double in 3 years, 3.5 years or so. 3 years from now, it might be worth $2.4 million. 6 years from now, it might be worth double of that, $4.8 million. But the key here is that you made an assumption that it will keep growing at 20% a year. And hence, you paid more than what is currently worth. That's value, that's growth investing. Sorry. And it's related to value investing because if you buy that same asset for $500,000, this rapidly growing asset, 20% a year. So not only did you have this margin of safety but the value also keeps increasing, right? So now your margin of safety in your asset is now getting bigger, and your investment is technically getting safer, and your potential returns are also going up massively. So they're tied at the hip. You
Right.
could also buy a rapidly growing company for cheap. That would be value investing. But traditionally, growth investing is not that. It's just, you don't care about the valuation, typically.
Got it. Got it. One question here. So, if I'm the person who owns that property, who knows that it's growing 20% year on year, then and if I'm familiar with the investment space, what are my different options? Why would I not go to the growth investor and seek a good valuation for my asset, and instead go for a value investor who's going to potentially undervalue my asset and take a safer approach to investing? What do you say?
Again, it depends, right? If you're in COVID and you have a lot of debt, you know fundamentally the company is good. It will survive. It just needs a bit of capital. Problem is, all the other, let's say you have a paper company and you need $10 million to stay afloat for the next 2 years. You're in the midst of COVID. Now, every other paper company is going bankrupt. So investors are typically not going to give you a premium at that point in time, right? So you only have a choice whether you wish to sell your assets and finance your debt obligation or satisfy debt obligations, which again is not possible because the asset makes you the money. So then you are not left with the business, typically, if you have a lot of debt. Or you have to accept the valuation that a private equity firm will give you at that point in time. So to answer the question, really, a good private equity firm, and this we'll get to, I guess, later on as well, will buy when the environment is good for buying, when things are trading at a huge discount, right? Which is to an extent what Brookfield does. They go into cheaper markets where capital is starved. There's no money. Banks are not lending money. Financial institutions are not giving you money. They're not investing you. There's no equity. There's no debt. Now, you have no choice. You have to take what you can get. Look at office spaces, right? Office real estate right now. Now, if you have a good office space, let's say in Manhattan, you probably are going to do well, regardless of work from home or not. But from what I've seen, something that was trading at $100 million is now trading at $26 million. And this is 3 years apart, right? Because money is not cheap anymore. You don't have a 3.5% mortgage. You have like a 7.5%, 8%. And so your debt obligation almost tripled. Now, there's going to be a fire sale. Banks are going to acquire office real estate, or they're going to sell off their already acquired office real estate at fire sale prices. So it's not that you always get cheap assets. It's only when the times are tough that you get them. And they might not always be cheap, because otherwise you don't make money. If I buy something for 50% off and it always stays that way, I don't make money. It typically, over time, you get a fair value for your asset, right? As the troubles go away, optimism comes back and valuations improve.
Right. Got it. Very interesting. And you mentioned about how different markets have different environments at different times, right? A certain market can be overvalued at a time, and a different market can be undervalued at a time and maybe starve for capital, right? And at Ironhold Capital, you are taking a global approach to investing, where you are investing into public markets of different countries, right? So tell us why you chose this global strategy of investing, and how do you evaluate different markets and where you should focus at one point of time?
So the reason why we chose the strategy is because we have foot presence in both North America and Asia, right? Specifically India and Asia. So we have the capacity to do due diligence. We can go out there, meet CEOs, do channel checks, meet distributors, see if the product's any good or not, speak to customers, speak to ex-employees. We can do things that most firms would not be able to do in the US because we have foot presence here. So that's one of the reasons why we are a global firm. The other reason is what we discussed before. Markets go through periods of over and undervaluation. So look at the US market in 2021, especially tech stocks. All kinds of tech names were trading for ridiculous valuations. These were companies with a lot of debt. Sometimes they were not profitable, but most often they were not profitable. And sometimes they had both. They were not profitable and they had a lot of leverage. So fundamentally, they were terrible assets, but they were given valuation multiples of 100 times the revenue because they didn't have any profits, so no multiple on earnings. Now, if you are a US investor and you're focused on tech, let's say, you have no option but to allocate capital. Because to see the stock market go up, it doesn't just go from overvaluation to cheapness. It goes from overvaluation to bubble first. So you don't feel like missing out as an investor. And it's hard to say to your clients that we're not going to participate in this 40-50% rally as you see with AI stocks right now because we believe they're overvalued. Your investors are going to get outraged by that because they'll see other investors make money. So as a fund, then you have a problem. If you're only in the US and the US is overvalued, where do you go? And it's hard to find cheap things when the entire market is trading at 30, 40 times earnings. So in 21, the US was not a great place to be. Even pretty much till early 22, it wasn't. It was only, I think, midway to, not even midway, I would say, towards the end of 22 that you saw any reasonable valuations. So we didn't have that problem. We could allocate to India, we could allocate to Europe, we could allocate to, the good markets, good stable markets that were cheap. And that's one reason why I think investing globally has an inherent advantage. Even right now, look at India. Right? There are small cap Indian companies that are trading at 40 times earnings, 50 times earnings, which is more expensive than a stable Microsoft, which is already very, very overvalued, is trading at 38 times earnings. Some small company that's not profitable or barely profitable, has no competitive advantage, is trading at 40 times earnings. The entire index is trading at, I think, 35 times earnings, the mid and the small cap index in India. It's extremely overvalued. If you deploy capital at this point in time, future returns look terrible in a place like India. So if you're only invested in India, which some of my friends are, the fund managers, they have a problem. They have to sit on cash. Who knows how long this bubble will go on? Maybe it could go on another 8, 12 months. It's a hard sell for your investors. They don't want to wait that long, especially in a rising market. So that's the core reason why I think globally, if you look at Brookfield Asset Management, what they do, they'll go to Brazil and buy a hydroelectric power plant when nobody's buying it, and they could get it for pennies on the dollar. Once that gets expensive, they might go to Canada. They might invest in India. In fact, they have presence here as well. So they move around capital to where capital will get very high returns potentially. And I think if you look at the returns, and this is no endorsement, of the big money managers, Brookfield is, I would say, about 2 times as better than anybody else. Right. Yeah, the returns are extraordinary.
Right. So you mentioned how the US market is overvalued, and what you said is the Indian market is also kind of overvalued at this point of time, right? Uh, and there can be different markets which are not overvalued. But there are different factors also to consider within that. That since India is a still underdeveloped economy in general, and there are more people coming into the financial cycle every day and investing their money into stocks, uh, maybe it's not a bubble, and maybe it can keep growing for a considerable amount of time, just because of the new people who are coming in the markets and investing their money, and the optimistic outlook that they have for it. So what's your take on that?
So that's the argument you get when you talk about overvaluation. That was the same argument in 21. Tech
Right.
companies benefiting from COVID,
Mm-hmm.
100% revenue growth. It's going to keep going. It will never end. And now we're 3 years in. I have investors in the fund who invested during this peak period. Their portfolios are still down 40%. They invested in these high-flying tech names. And we're almost 3 years in at this point in time, and you still have negative returns. So fundamentally, there's the quality of the asset. Of course, you want to buy great assets, but you also want to buy them at a sensible price, because just buying great asset does not work. You could look at some of the, Microsoft, for instance, in 2000 was trading at $60 a share. And in 2015, adjusted for splits, I think was 120. So in 14 years, you double your money, which is a terrible return. It's not even like 7%. You're looking at single-digit returns. But Microsoft, the business, the asset, that did exceptionally well over that 14-year period. So then why didn't the investors make money? Well, because you paid a valuation that was excessive. And when you do that, when you pay 30, 40, 50 times earnings, if the future is not extraordinary, then you will lose money. If it is extraordinary, you will earn okay returns, 13, 14, 15% a year. So there's no win-win situation. That's a lose-lose situation. Even if you're right, you don't get asymmetric returns from those valuations. So you see that with AI stocks now. For NVIDIA to justify its valuation, and this is not a stock recommendation, the future has to be absolutely perfect. And there can't be any hiccups, which means you don't think there are business cycles, which means you don't think new competition is going to come in. You think the current CEO and management team is going to be there a decade from now, which also means a decade from now, there's still growth left, because you still need a big multiple at the end of 10 years for you to make money on this stock. So it's not impossible, of course, but the odds of it actually happening are playing out. The moment you be 30, 40 times earnings, the odds are very much against you. And now there's no margin of safety, right? You can't afford to be wrong. It's flipped now, right? There's a margin of danger.
Right.
So
Got it. Makes sense. And now to close this out, let's do the rapid fire round, wherein I'll ask you 4 quick questions, and you have to give 4 quick answers, right? So the first one goes, what's the type of hedge fund that you run?
long only global value focus fund.
Got it. What's your geographical focus?
North America, India, some parts of Europe, and, well, typically the entire globe. But opportunistically, those are the...
Got it. Where can our listeners learn more about Ironhold Capital?
They could certainly Google us, right? Ironhold Capital on Google. They'll find our website. They could find us on YouTube. We have a show called Leaders in Business and Investing or you could just type in Ironhold Capital. Channel will probably show up there. So you could find us that way. We are also on LinkedIn. If you search my name and Ironhold Capital, I should appear there as well.
Right. Awesome. And the last one was, where can our listeners follow you? I think LinkedIn is that place, right? So I will make sure to put all those links in the show notes below. Thanks so much for making time for this. So that it's been an incredible conversation and a very insightful one at that, for myself personally, and I'm sure for listeners as well. Thank you so much, Siddharth, and I wish you all the best.
Thank you. It was a pleasure speaking with you. Wish you all the best.